But first, to our top story. It finally happened. WeWork is pushing back its IPO. What was once one of the most highly anticipated public debuts of 2019 is now postponed until October. The shared office-based provider is looking for more time to calm investor doubts about its dropping valuation, governance problems, and financials. Remember that at one point this was supposed to be a $47 billion company. Now that number is about $15 billion and perhaps even smaller. Joining me to discuss in New York, Phil Haslett, the co-founder and chief revenue officer at EquityZen. EquityZen is the secondary marketplace for pre-IPO shares. And also in New York, Bloomberg's Crystal C, who has been covering this troubled IPO. So Crystal, let me start with you. What was the problem today? Is it valuation, financials, or governance problems?
Taylor, is all of the above. The simple answer to this question is they have a lot of things to address before they can go out to the investors again and ask them for their money. Like you said, they were looking for a $47 billion valuation, and now we're hearing it could be as low as 12 to 15. And you know, they have actually made a lot of changes to corporate governance, but investors are really looking at, valuations, whether they will improve their performance, financials, and whether more changes are needed to corporate governance structure in order for them to be convinced about the valuation that they want to get.
Phil, this morning on The Open, they spoke with Gene Munster, who co-founded Loop Ventures. He had some comments, particularly as it related to the valuation part of WeWork. Take a listen.
That valuation, I think, is really a wake-up call to private investors that the public markets are holding them accountable. And the specific reason I think this report reflected that is the amount of cash burn. What is a consistent theme in your setup here address this is that companies that are losing a lot of money, not surprising, are being held to lower valuations. In the case of WeWork, it's $1.5 billion over the last year, which is more than what Tesla lost. To put that in perspective.
Phil, react to those comments on valuation.
Totally. So, I would say WeWork is kind of in a space of its own, having lost $2 billion in 2018. I think in a mix of Lyft, Uber, and WeWork coming or planning to come public in 2019, I think we've seen really like the largest losing companies coming out of kind of the pre-IPO tech space. At EquityZen, amongst these types of groups of companies, we also see plenty of companies that are burning only $100 million to $200 million in cash. I think WeWork is certainly an exception to the norm, but gosh, writing off, $37 billion of value over the period of 3 or 4 weeks is certainly going to catch the attention of a lot of venture capital investors and also public market investors.
Phil, we can joke on Twitter all day long about how you value a company using the discounted cash flow model for a company that does not have cash flows. But on a very serious note, how do you value this company?
Sure. So with WeWork, the first thing we looked at was trying to look at a multiple of revenue and some of the competitors that are publicly traded. And the first thing that we found at EquityZen, through our research, was that some of their competitors like IWG were trading at, I think, 1 or 1.5 times their revenue. WeWork earned, I think, about $2 billion of revenue in 2018. So to come out at a $47 billion valuation seemed ludicrous on its own front. I think the toughest thing for WeWork is trying to explain and defend itself as a technology company, where in reality, it really is a real estate company that happens to have some technology bells and whistles. And so I think this really is a big wake-up call for them to maybe recalibrate those expectations, maybe in Q4 or even a little bit later in 2020.
Crystal, bondholders also had a recalibration of expectations today. I want to show a chart on the Bloomberg terminal for our audience, which shows the price of those WeWork bonds that are now falling a record amount this morning, more than 6 cents on the dollar, gone as low as 95, now hovering around 97 cents on the dollar or so. How nervous do bondholders continue to be?
Some of this credit facilities is contingent to how well the IPO perform or whether the IPO happened at all. So WeWork put out this statement this morning saying that they are committed to completing this IPO within the end of this year. So that should give bondholders a little bit of a confident boost, but the valuation continues to be the biggest concern because some of that value of the bonds are tied to how well they perform. If it becomes a 15 billion company instead of a 47 billion company, then bondholders are going to get nervous.
Phil, talk to me more about that valuation. What did the private market see that the public markets are missing?
Sure. So one of the interesting things we saw at EquityZen, where we see a lot of kind of pre-IPO secondary flow before companies go public, is that there actually wasn't that much interest for WeWork, particularly at the valuations that it had attained from SoftBank and from other investors in primary capital raises. You know, we saw much healthier markets for companies that went public recently in 2018 and 19, companies like DocuSign, companies like Slack that were a little bit more popular with investors, and we kind of would have expected to see something similar for a company like WeWork because the brand is so ubiquitous. However, there was a little bit of hesitation from some of those investors of that lofty valuation. You know, when you get north of $20 billion in valuation, you know, you're not talking about hundreds of unicorns there anymore. The number of decacorns or whatever unit you want to call really drops precipitously, and particularly when you have that kind of valuation coupled with losses of, you know, north of $2 billion, I think was just kind of a recipe for disaster here. And one thing I think about is that we've been in very much a bull market, not only in public stocks, but also in private companies. And that has led to founder-friendly terms on how they've raised capital. And at some point, you are going to have the pendulum swing. And I think when you have this type of headline cut in valuation will really start to shift those types of numbers over to investors that are going to start to ask for more corporate governance, more reasonable valuations, and other parts within the cap structure that they'll get more comfortable with.
Crystal, when we were talking about bondholders, you mentioned that a $6 billion financing was contingent upon raising $3 billion in that IPO. Assuming that doesn't happen, when does WeWork need to get more cash, and where do they get it?
I think the very simple answer to that question is they always need to get more cash as soon as possible. If the IPO doesn't happen by the end of the year, you know, they may look into tapping to SoftBank to get a bit more funding. And there were actually some talks about SoftBank being willing to put in another couple $100 million into the company, but that would not move the needle. They would definitely want to do an IPO to, you know, recapitalize.
Phil, quickly here, any ideas on when is their drop-dead deadline for raising more cash?
Gosh, I got to think that they might want to push this over to 2020, but with only about $3 or $3.5 billion of cash available to them, things could get really messy here starting in Q1 of 2020, particularly if a lot of the lenders that have promised to provide them capital if they raise their IPO before 2019, they're going to kind of put them in this tight bind. If I were them, I'd spend the next quarter really tightening the belt and trying to overhaul spending, show some great numbers at the end of Q4, try to renegotiate with some of the banks and try to list in Q1.
Phil Haslett of EquityZen and Bloomberg's Crystal C, thank you both for joining me.